Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to this penultimate installment of our Through the Noise podcast mini-series, where we will discuss the Q2 market outlook titled Staying Safe. Today we will focus on the opportunities in currency markets, and to do this I am joined by Manpreet Gill, our Chief Investment Officer for Africa, the Middle East and Europe, and he joins us from Dubai. So Manpreet, a pleasure to talk to you as always. I guess let's start at the top and with the US dollar. So, a case that we often hear from our clients is that if the US enters a recession, then the dollar should strengthen. However, we believe there's going to be a recession, but we also believe that the dollar is going to weaken over the course of the next 3 and 12 months. So can you help listeners reconcile these two views?
Hi, Steve. That's absolutely right. I think that's an argument we come across quite a few times, and that it can be sort of argued that the dollar, in the past has strengthened during some U.S. recessions or other environments that have led to a risk-off environment. But what I will say two things around that, though. I think one is that the track record is arguably quite mixed. It's not something that's happened with a high sort of degree of incidence. And second is that in this environment today, we do believe the dollar's eroding yield advantage is likely to be the dominating factor. When you think about that driver of currency markets, we do expect both 2-year and 10-year US government bond yields to decline over the next 6 to 12 months. And that, of course, we believe will erode the dollar's rate advantage. In addition, we actually believe the dollar smile framework also argues for a weaker dollar. And just to understand what I mean by that, imagine a big sort of smile where the dollar does well in either of the two extremes on the sides. Market stress on one side, but also US exceptionalism on the other. But it actually weakens in the middle when global growth tends to be in line or at least better than US growth, which is the environment we expect. And lastly, despite what's been about a 10% decline from October 2022 highs, the dollar still screens as quite expensive relative to its fundamental factors. So those are the reasons why we believe the dollar is likely to weaken modestly from here. Of course, the key risks to that view, one, of course, that inflation is more persistent than we expect, or that US growth indeed slows much more dramatically than we expect, which would push us, of course, to one end of that US dollar smile. But outside of those risk events, we do expect the dollar to weaken moderately.
Okay, so a weaker US dollar usually means a stronger euro. So do you see the euro as one of the beneficiaries against this backdrop?
Well, yes. I've often say that the euro is sort of a bit of a default anti-dollar currency. So we do expect that factor to a moderately weaker dollar to be the benefit, to the benefit of the euro, both on a 3-month and a 12-month horizon. But I would point out that it's not just about dollar weakness. And if you look at the euro area for a moment, inflation is still elevated, which is why we expect the ECB to hike rates by another 50 basis points, but then stay on hold until at least the end of the year. And that, particularly towards the end of the year, should give it a bit of a yield edge over the dollar. Meanwhile, we've also got lower energy prices, which have helped sort of lower European inflation to some degree. And that, of course, starts increasing the real or net of inflation interest rate differentials more so in favor of the euro. I'd also note that lower energy import costs could cause a current account surplus over the next 12 to 18 months. And that, together with improved portfolio flows, should result in favorable demand supply technicals for the euro. So all in all, wrapping that together, what we expect is euro dollar to potentially break more sustainably over resistance at 1.10 over the next 3 months before gradually trending higher towards about 1.13 to 1.15 on a longer 12-month horizon.
Okay, let's extend this to other European currencies. I guess last year was a pretty volatile year for sterling around the Truss administration and the fiscal mini budget, if you like. And then Swiss franc's been more in focus in recent times given the banking sector challenges there. So does this view of what's happening in the euro extend to the sterling and also the Swiss franc?
Well, I'd argue it does, perhaps more so for the pound sterling than the Swiss franc. Now, when it comes to pound sterling, that's part of the reason why we've turned more optimistic, particularly over the next 3 months, expecting, of course, an appreciation towards about 1.24 to 1.25 against the dollar. Now, In addition to dollar weakness, our view, of course, is sort of comes on the back of what has been relative resilience of the UK banking system more recently, and of course, going back beyond that, progress on the Northern Ireland Agreement. We think both of those, of course, are likely to help sentiment. But of course, once we go beyond that 3-month horizon, we do expect the pair to remain in about a 1.24 to 1.27 range, because the Bank of England does sort of have to balance what we're seeing on inflation with what is still quite a challenging domestic growth backdrop. That's, of course, on sterling. When you think about dollar Swiss franc, though, we're expecting more of a range-bound outcome around 92 cents to the dollar, with, of course, 90.4 cents acting as a key support on a 3-month horizon. Near-term risk on sentiment, does reduce safe haven demand, but of course, we start having more of the conversation around recession risks in the second half of the year. We do think dollar Swiss franc could decline modestly towards about 90 cents on the dollar on safe haven demand, but also supported by the Swiss National Bank's stated willingness to sell FX reserves if it has to, in order to maintain a relatively resilient Swiss franc to, of course, contain imported inflation.
Okay, let's move closer, maybe to my home, not yours, but into Asia. I mean, the yen and the other Asian currencies, are they likely to gain more strongly on the back of a weaker dollar?
Well, potentially, yes. I mean, the yen is the one we normally look at when looking for a currency that tends to move by large amounts. But the additional key factor today is where monetary policy goes from here in terms of yield curve control policy. Now, we do expect Bank of Japan to gradually normalize monetary policy, but the recent banking sector turmoil and, of course, what we've heard from Governor Ueda, in our view, increases the risk of a slower than anticipated normalization. That's why when you look over a 3-month horizon, we expect the dollar yen to trade in a more range-bound manner, in about a range of about 128 to 132 against the dollar. It's really when we come to a longer 12-month horizon is where we expect dollar yen to push towards about a 120 to 125 range, both on the back of favorable yield differentials and possibly a potential increase in safe haven demand. So that's on the yen. I would say on the Chinese renminbi, that's one currency we also expect to benefit from a weaker dollar and what is a faster than expected economic reopening in China. And I would point out that renminbi could be a more direct way to gain exposure to the China reopening as opposed to, say, commodity currencies, which is another common place to look, because China's focus at the moment is clearly more in consumption rather than investment-led recovery, and that, of course, arguably less of a tailwind for commodity currencies, which also face some vulnerabilities from housing markets in Australia and Canada. In terms of other Asian currencies, we do expect currencies like the Singapore dollar, the Korean won to benefit and trend higher as the dollar softens. I would point out that the Indian rupee, of course, could see stronger support from what has been strong domestic growth and, interestingly, a declining current account deficit. But we do believe that will be blunted to some degree by central bank efforts to rebuild FX reserves, and that could put a lid on gains there.
Okay, thank you, Manpreet, for providing your perspective. Unfortunately, that's all we have time for today. And thank you, listener, for joining us today as well. On Monday, we'll wrap up this mini-series when I will discuss our sector preferences in the US, Europe and China with Fukien, who runs our Sector Investment Committee. I look forward to speaking to you then.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.